Okay, we are live streaming on Facebook. This is Ron Sneller, financial services professional by day, professional wrestler by night, and I am here with a great friend and colleague of mine, Mike Raths. Mike is a $1 million roundtable producer in the financial services industry. That means that he is in the top 1% of all producers, meaning that he has a ton of clients who love him. He's an absolute wealth of knowledge. But most importantly, he's a family man, he's a Catholic man, and he is a relatively new father. Mike, your daughter is what, 5 months old now?
5 months, yeah, a couple days ago. Well, 3 days ago, really. It's the 10th. So, yeah.
Congratulations, man.
Yeah,
Congratulations.
she's doing great. So
that's awesome.
Yeah.
Well, you and I, we go back a long way. We've known each other for a long time. In a former life, I was a teacher, and I had you in high school for history class, and you're quite the history buff too, aren't you?
Yeah, that's kind of my forte: history, politics, economics. And translates well into this business.
Absolutely. So, and we're going to dive into that as far as politics and government and some of the impact that it's having on not just the financial world right now, but what it may mean for the future as well. But you have a political science degree, correct?
Yeah. U of M Flint, political science. So
okay,
that's where I went.
Awesome. Mm-hmm. And it looks like you are downstairs in your basement, I imagine, trying to get some peace and quiet for this conversation with a 5-month-old, not crying and whatnot.
She's awake now. She actually just woke up, I don't know, maybe like 20 minutes ago. And she's at the stage now where she really likes to talk and like scream, like she's really finding her voice. And usually she's the most alert and the most talkative in the morning. So if I was sitting upstairs in my office, you'd hear like little baby screams and baby babbles. So
that's awesome.
It's cute, but it's like so distracting.
Yeah.
So it's hard to focus.
Yeah. For this conversation, I had to go to my office outside of the house because I have a soon to be 3-year-old and a soon to be 1-year-old. And it's kind of the same thing as you're experiencing, except times 2. So
fatherhood problems.
Fatherhood's amazing, but
it's first world fatherhood problems.
Exactly.
To go to my basement to do this podcast. Jeez.
For sure.
Oh my gosh. Tiger's not chasing me though, so I guess I'm doing all right.
There you go. Well, listen, we're going to jump into some of the current events and things that have happened this week, how they're impacting the financial markets and how that impacts a person's financial planning, both for the short term, but especially in the long term as well. So a couple of things that happened this week. We saw some incredible volatility in the stock market on Thursday and Friday, but especially Thursday. And so the stock market lost 7% just on Thursday. It lost about 6% just in the last hour of trading alone. So, I mean, those are just numbers, but what does that actually mean? I mean, let's make a comparison, right? And you're well aware of this, but if there's a retiree who they've retired and they've got all of their money in a managed money fund, like stocks, bonds, whether it's a 401k or a brokerage account or whatever, the safe withdrawal rate based on the low interest rate environment and the volatility of the stock market, the safe withdrawal rate is 3% per year of that account, right?
Yep. Pretty close.
Meaning if somebody has $1 million, they can safely withdraw $30,000 per year and pace themselves throughout retirement. And there's a 90% chance they won't run out of money. So 3% per year is a safe withdrawal rate. Well, looking at what happened on Thursday, they just lost 2 years of income in an hour. 6%. They lost 2 years of income in an hour.
Yeah.
So talk to me a little bit, and not just me, but everybody who's maybe watching this podcast, talk to me a little bit about that. And when people are planning their retirement, but also when they're in retirement, like navigating those rough waters and the things that can happen. Tell me about like what they can do and what kind of stress that can cause them. And maybe we can just give a little brief synopsis right here, and we'll dive deeper into detail here in a few minutes. But just, do you have any initial thoughts just on that concept?
Yeah. I think it leads in perfectly to what our Slow clap while I mention his name. Tom Hegna likes to say, a just in case retirement. And a lot of people have in their head, like, they know their gut feeling. They know that there's going to be volatility and that the market is kind of, people just expect that. They just expect the market to be all over the place these days. And the just in case retirement mentality, basically, well, I can't really take out too much money because what if the stock market, like just the other day, what if the Dow goes down 1,000 points and I take out too much and I run out of money? Well, that kind of, the biggest problem is it kind of implicitly forces people to live maybe a subpar retirement. Maybe they don't enjoy it as much because they're afraid to spend their money. They're afraid that they're going to one day, I'm 65 now, but I'm going to live until, people these days are living until their 90s. And, I'm 65 now, but if I take out too much and the market gets too volatile, what happens? What kind of retirement am I going to have when I'm 75 and I run out of money? Or I only have 3 years left of income and I'm 75. What am I going to do? Am I going to go back to work? I'm 75 years old. Who's going to hire a 75-year-old? What company is going to hire somebody who's in their 70s or 80s? They want somebody, right? Don't a lot of companies want someone who's going to stick around for a little while? So if you're a retiree and you're facing all this volatility and, like we discussed earlier, the withdrawal rate, you can only take out safely 3% without having the fear of running out of money. I think a lot of people kind of, with having that an anxiety of possibly being at a phase where you can't go back to work because you're not healthy enough, and running out of money, I think a lot of people, they sit on their money. They don't really pull it out and spend it and enjoy their retirement and have fun and, take trips, or I don't know, maybe their grandkids live in different states these days. It's not uncommon to have kids and grandkids all over the country. And, it's kind of sad because maybe if they weren't so worried about the volatility and they had some kind of volatility buffer in their portfolio, maybe they wouldn't feel so bad about spending their money, and they could actually just do what they want to do and not worry about it. But
absolutely. And there's strategies and solutions for that. And we're going to get to those later on in our discussion today. But I think you pretty much hit the nail on the head for some of the basics, like that. I guess the fear or the anxiety and the stress that people face, both when they're heading into retirement or if they're already retired.
Yeah.
So I think that's really key.
And people know, people know that especially the last 20 years, we've had a tremendous amount of volatility in the market, like more so than in the past, I think, than in like the 60s up until the 90s. I think people know that these massive swings in the Dow, it's, to borrow a phrase that I absolutely hate, but it is kind of the new normal, isn't it? Isn't this volatility in the stock market isn't it kind of just, it's just the way it is? It's like gravity now, right? Isn't that just the way it is now? So,
well, I think you're right. Part of the problem is that throughout the 80s and 90s, when we had this huge generation of baby boomers, where they were in their peak earning years, they were in their peak spending years, they were raising a family, and the American economy was booming and growing through the 80s. Right. And then in the 90s, the boom of technology made things grow even more. And people were averaging 10, 12, 14% return on their stock market investments during that time.
Right.
And they thought that was normal. Now, the problem becomes is that people still think that they can rely on 10, 12, 14%. I mean, you hear people like Dave Ramsey talk about that online. Now, Dave Ramsey is not licensed in any way, shape, or form, so he can't be held accountable for his terrible misinformation on that topic. But since the turn of the century, since January 2000, the average return, the real rate of return in the S&P 500 has been about 4%.
Mm-hmm.
And if you reinvest all of your dividends, it's around 5%.
Yeah.
That's a far cry from 12%. You know,
Right.
and why is that? Oh, well, because we had a huge drop in 2000 through 2002. We lost almost 50%. And then it took more than 4 years to recover just to get back to where it was. And then guess what happened 2 months later? By then it was late 2007. Then we saw another 50% drop. So literally from the year 2000 to 2010, it's called the lost decade because the average returns in the stock market during that 10-year period, they were actually negative.
Right.
Now the key though is since that time, for the last 10 years, we've had a tremendous boom again in the stock market where it's averaged about 10%. And if you've reinvested all dividends, it's been about 11%. So, that's really a key when you look at retirement planning is that you mentioned the phrase earlier, like a volatility buffer. If you have a non-correlated asset class that you can draw against during the downtimes and protect your investments that way, because think about it. If you draw off your investments because you need to for income while they're low, you're locking in your losses. And it's really a double whammy, right? Because not only are market forces pushing the value of your investments down, but then you're actually taking money out, which it accelerates the decline so much that you can't ever truly recover. And many people just don't know that. They think they can rely on 10, 12% return on the stock market for the rest of their life. And the recent history shows that that's not even close to being true. Now, like you said, the new normal. Why is that? I don't know. Is it government intervention? Is it because they're messing with tax rates and they're printing so much and they're doing all that kind of stuff? I know that you're political science. I'm going to turn this back over to you because I want to know your thoughts on the government intervention and the tampering with the money supply and with tax rates and things like that.
Right.
Like what do you see? Give us your expertise on that.
Yeah, that leads in perfectly to a discussion on economics and politics, because when you look at the stock market, well, what is the stock market? You can ask a lot of people, well, what's the Dow Jones? I don't know. It's just on Fox Business or CNN or, CNN Money. And it goes up, it's good. It goes down, it's bad. Well, what is the stock market? The stock market is basically a valuation of the profitability of an amalgamation of businesses, right?
Mm-hmm.
It's
right.
How do people perceive the prospects of success or failure for a company, and their valuations are reflected in the stock market. So in a time of economic growth where, corporate earnings are up, employment is up, investment in, new products or building new locations or potential for hiring more people or releasing building new locations, that kind of thing. All that reflects positively in the Dow and the S&P. And then the inverse is true, going the other direction. Now the problem is with economics, organically, the economy left to its own devices, there's going to be a natural flow for business. There's going to be, there's going to be just an organic coming together and cooperation between the producers and the consumers. And, supply and demand will naturally work things out. What we're seeing today, though, is a more top-down nudging and pushing of the economy by the Federal Reserve and the federal government, where instead of, say, like, I don't know, let's just say in an organic economy where there's very little manipulation or tampering, you might have one sector of an economy get overinvested in, and maybe some mistakes are made, right? Some people think, oh yeah, this investment's really going to pay off, so we're gonna pile some money in here, and it might not pay off, and some businesses might go bankrupt, and people could lose their jobs, and, could be bad for that area, for that industry, maybe, I don't know, automotive or something like that. Right.
Right.
But it's not going to be systemic and affect the entire economy. Right. Well, what we have right now, for example, the Federal Reserve having interest rates artificially low. Well, interest rates affect literally everybody. So instead of having, malinvestment in one area of an economy left to organically, come to supply and demand, but what the consumer wants cross-reference to what the producer wants. Well, low interest rates artificially inflate investment everywhere.
Mm-hmm.
And it encourages spending in the here and now by the consumer, because the consumer can't get a halfway decent return on their savings. So it encourages artificial consumption on things that might not necessarily be profitable. And there is a day of reckoning for that. And that's, the boom and bust cycle that we have right now. When interest rates are artificially low, a really good analogy for that would be, hey, Ron, if I were a bank and I said, I will let you borrow $1 million from me for 0% interest, what would be the chances that you would take that loan for $1 million?
At 0% interest?
Yes.
I absolutely would take it.
You would absolutely take it.
It's free money. Why wouldn't I?
Right? Yeah, why wouldn't you?
Yeah.
Well, so how many of these businesses are borrowing money so levered up with debt? A lot of these corporations, like corporate debt levels, are at like all-time record highs right now. Well, a lot of these corporations, I mean, you kind of can't blame them in a way, right? Because if the government's offering it to them and their competitor takes it, but they don't, they could maybe lose a massive amount of market share.
Right, because their competitor can expand, right. They can innovate. Yeah,
exactly.
Okay, yeah.
So everybody's doing it. Everybody's borrowing at 0% interest, getting herding money into places that the consumer doesn't necessarily want. Because when a business sells you a product or a service, there has to be a demand for it. There has to be an organic demand for it. Otherwise, it's an unsustainable business model.
So would you say that, based on everything you're saying, there's a lot to unpack here. You put so much great information, just into that one little section. But would you say that part of the compounding problem is also the fact that these corporations are borrowing all this cheap money? They're making investments maybe where they shouldn't even do it because there's not really a demand. But if they kind of go bust, I mean, hasn't the government given them some artificial safety nets where there's really no true consequences or ramifications because the government's bailing them out, whether it was the auto industry 10 years ago or just recently with the airline industry? And what does all that mean? Yeah.
And that's another great thing too, leading into the investments that might not make any sense argument. A great example for this is Hertz, Hertz Rental.
Right.
And you heard they're going bankrupt, right?
Right. They just, a week or two ago.
Well, they're not the only corporation who's going to have to go through this. So basically, this is a really interesting case study. And it's basically that, in my opinion, I think it's a canary in the coal mine kind of thing. But what a lot of these companies are doing, they're borrowing money from the banks and the Federal Reserve at very low interest, 0% interest basically. And what are they doing? Are they building new products? Are they hiring more people? Are they streamlining their business to make them more competitive? No, they're buying back their own stock, and then they're selling their stock when it goes up. So it's basically just shuffling monopoly money around on a board game, right?
It's so interesting that you bring that up, because I want to give you two headlines I saw this week. Yesterday, I saw a headline, and I don't remember if it was from Yahoo Business or Market Watch or whatever it was. I don't remember, But what it said is that the stock market is the most overvalued it's been in the last 20 years.
Yeah.
And then this morning I saw on
right.
CNBC, Jim Cramer from Mad Money, he said, this is the most overbought market in history. And I quote, it got too easy. And now we all have to suffer as the get rich quick crowd gets blown out.
Yes.
He said that yesterday, because it's been so volatile the last couple of days. So can you maybe speak to that with the manipulation and this, just continue on with like some of that? But what is it? Let's try to like get back on track here, because you and I could talk economics for hours.
Sure,
I think. But what does it mean for like people planning in the future? Would you say that the more tampering they do, like the more volatile the swings are, like higher highs and lower lows? Because that's what it looks like to me. Like, what are you seeing?
Yeah, so like going back to the Hertz rental thing, so like the stock market being way high and way low, well, if all these companies are buying back their own stock and they're not really using the investment for new products or new services or like something that actually benefits the consumer. Right? Because what a corporation is a business, and they sell a product or a service to a buyer, and the buyer is better off. Like if I buy a car, I'm better off because I had some money that I wanted to spend, and I bought a product that I wanted that fulfills my desire as a consumer, and that corporation wanted my money more than the product that they were selling, so we exchanged voluntarily, right? So we're both better off. Well, if they buy back their own stock, who benefits from that? Well, not the consumer, not at all. Well, with Hertz Rental, a few years ago, their stock was like $60 or $70 a share, and they bought their own stock with these 0% interest rates. Well, with this whole coronavirus stuff and the shutdown, well, the demand for rental cars has just absolutely plummeted.
Right.
And with Hertz Rental going into bankruptcy, they bought back their own stock around like $60 or $70 a share, and now they're selling their own stock right now for like $30 a share. So they lost like half their value in their stock buybacks. And so they're dwindling organic demand for their actual product and service that they sell, and dwindling return that they can get on selling their stock that they bought back. So they're screwed.
So isn't that what also happened with the airline industry and like with Boeing? Because I thought I heard that recently Boeing did a bunch of stock buybacks, and that's why they didn't have any cash, like as an emergency reserve. And then when the coronavirus shut everything down and they weren't doing any business, they had no cash reserves because they used all their cash to buy back their own stock.
Right.
But then the government came in and bailed out the airline industry again, is my understanding. I don't know exactly what those numbers look like, but so it almost sounds like the government is picking and choosing. Well, at the rental car industry, that's not a big enough industry. That's not too big to fail, so we're not going to rescue that. But the airline industry is too big to fail, so we are going to step in and rescue that. So am I understanding that correctly, or is it a little more nuanced than that?
Yeah, I think so. That's kind of the system that we have right now, though. A lot of people will say that America is a capitalist country and we have a capitalist economy, and we'll hear a lot of lip service to that, but we really don't. We have really a corporate fascist economy, which is basically an intersection and a union between big business and big government. Well, in a fascist economy, the government allows private ownership of the means of production. So people, CEOs, not that CEOs are bad guys or anything like that, but basically the government sets the rules and they allow private individuals to profit enormously when times are good. But when times are bad, they socialize the costs of the bad times to the taxpayers. So people are allowed to profit. The government allows people to profit as long as they, play ball and follow the rules that the government sets. But like the whole too big to fail thing, like when the banks were going out in 2008 and in this situation too, and the airlines and all these other companies, they're allowed to profit, when they're making money, but when they're really losing money and they're doing terrible, then the government steps in and they allow them to profit. So people are Well, the government socializes those costs on the taxpayer and bails them out, and you don't really address some of the issues, because if you let's say you have bad leadership for a corporation, or really toxic assets or bad investments, well, when times are really bad, what's the best way to have a big reset for that? Well, going through bankruptcy proceedings, right? Once you go through bankruptcy proceedings, what usually happens? Well, they get bought by somebody else who is a more competent manager of those resources. Usually they'll fire the people who ran the company into the ground, or they'll say, why in the hell do you have money going into this place? This is a terrible investment. And, money gets moved around and put into more profitable uses, and the company will typically be better off for it. And the consumer will be better off for it, because the company going through bankruptcy will be more streamlined, more efficient, more responsive to organic consumer demand. Well, if that reset isn't allowed, well, what does that do? It just guarantees that that's going to happen in the future, doesn't it?
Right.
Because if you don't get rid of your bad leadership, if you don't get rid of your bad investments, if you don't change the ethos and the attitudes of the company that failed, aren't you basically rewarding failure?
Absolutely.
So,
and
I mean,
you said something that was a key where you said, yeah, absolutely. And you said something recently that really struck a chord with me too, and probably a lot of our viewers, when you said that, the government ends up putting all the onus on the taxpayer,
right,
when they bail these companies out through, the printing of money and running up this debt, and it will ultimately get passed on to the taxpayer. So here's a couple other things that happened this week, and I want to get your thoughts on these as well. So there's a really cool website called the usdebtclock.org that tracks a lot of our spending, a lot of our, our debt, our obligations, demographic factors, things of that nature. Well, we just went over $26 trillion in debt this week.
I saw that.
And we've added $2 trillion in just the last 60 days during this coronavirus era.
Jeez.
So that's crazy enough as it is. But the debt clock has a projection. If we don't cut back, we keep going on the route that we're on, that in just 4 years, by the year 2024, it projects our debt as a country to be 46 trillion.
Jeez.
46 trillion. At the beginning of this year, it was, I think, 23. So they're saying in 4 years, that's going to double.
Jeez.
2024, it'll be 46 trillion. And the other problem that I see when you take the 46 trillion come in 2024, combine it with the fact that the current tax law, which is very low taxes, that expires in year 2025. And is the government going to need more revenue here in 5 years? Sure. Yes or no?
Yeah.
And then the other thing that's, really concerning to a lot of business owners and, financially success-minded people is that there's more and more socialist thought pervading our economy. Things like universal basic income, free college, free healthcare. And if these types of people who have this, type of political and, monetary policy, if they get into office and they can implement this monetary policy, what is that going to mean for the taxpayer? What is it going to mean for the people who are running businesses and the people who are, financially successful and they're earning 80,000, 90,000, 100,000 or more? What is that going to mean for us now? And then more importantly, what is it going to mean for the guy 20 years from now who has done the long-term gratification, who has sacrificed, who has disciplined, who has saved, who has invested, and he has $1 million and then he retires? I mean, is it possible that his tax rates are way higher in the future? So can you give me your thinking on that situation and just go a little more in depth on what you see happening as far as the potential problems?
Yeah, that's another big concern that I really see talking to people and with what we do is not only how we've been talking about all this volatility and maybe some of the sources that could contribute to the volatility, people are also concerned about, how much money of mine am I going to get to keep? So, I have all this volatility in the stock market that is a problem, right? And then on top of that volatility, it's kind of like, okay, well, I managed to navigate that somehow. Now the government is going to penalize me with onerous taxation because of profligacy and higher spending and just irresponsibility. And it's from both parties. It's not a partisan thing. So yeah, that's absolutely a concern. And when you talk about the whole debt clock thing, one of the biggest issues is that there's a lot of things that the government spends money on, right? There's a lot of things that maybe you and I disagree with, and that could be a conversation for another day about, what are they spending money on and what should they be spending money on?
Yeah.
We could talk all day about that.
Yeah.
But the two main ones are Social Security and Medicare. Those are like the largest things in the federal budget.
Right.
And then defense spending. Well, on that debt clock thing, if I'm not mistaken, didn't it say that the Social Security Trust Fund is bankrupt in like 2032 or something like that?
I think it's 2034.
Is it still 2034?
Yeah.
So that's another thing. I mean, you have all this extra spending that we just did to help fight the coronavirus crisis, which is definitely exacerbating an already existing problem.
Mm-hmm.
And then you have all these unfunded liabilities and unfunded commitments we've made through Social Security and Medicare, and the money isn't there. It just isn't.
Right.
So what are they going to do? I mean, the Jerome Powell, the chairman of the Federal Reserve, he's already told the public that he will do whatever it takes to fund the Treasury. Basically, he'll print as much money as possible. He'll print as much money as is necessary, but you can only print so much, right?
Well, that's the thing until we become like Argentina or Zimbabwe.
Exactly.
I remember Ben Bernanke saying something along the lines of they'll drop money out of helicopters before they let the country go into deflation.
Helicopter money, yeah.
That was Ben Bernanke, right?
Yeah. Well, was it? It was either him or Jerome Powell, I think.
No, it wasn't Jerome Powell. It was a while ago. Yeah.
Oh, okay. Yeah. They did say that. Yeah. It's funny, but it's not funny.
Well, think about it for a minute. So, I mean, this is the guy who has his hand on the spigot of the money that you work so hard to earn.
Right.
And I think part of that problem, and I know Mitt Romney got crucified a few years ago for saying this, but I'm not worried. I can take the heat. But you've got nearly 50% of this country who effectively pay no federal income tax.
Right.
So they don't care. I mean,
sure.
And there's a lot of, issues in our country with, poverty and levels of education. And if you look at the median income in this country, you can actually see that on the debt clock. It's about 34,000.
Sure.
34,000 per family, which is, that's barely above the poverty line.
Mm-hmm.
But look, for most of like middle America who are, working their tails off to make ends meet and, get ahead and save money and prepare for the future, to hear that they're just going to drop money out of helicopters if necessary, that's a bit concerning about what is that going to do to the purchasing power of the money that you and I have worked so hard to earn and to save.
Right.
So let's transition a little bit here for the last 10 minutes or so, because you are a $1 million roundtable qualifier. So in the financial services industry, what that means is that you are in the top 1% of all professionals as far as the amount of business that you do, client acquisition, like premium dollars and dollars coming to you. And so obviously you are very good at working with clients, communicating these concepts to them, And I know that you're just really big into asking questions and helping them kind of come to their own discoveries as far as like what they should do with their money. And then once they decide like, yes, we have to do something, like then you help give them guidance to go in the right direction to accomplish their goals, like what they're trying to do. And not everybody's the same, obviously. But can you now kind of share, like, what are some of the questions that you ask people, like just in addition, obviously, to what you and I have already discussed, but what are some of the questions that you ask people when it comes to their financial planning and their retirement planning, that would maybe address some of these concepts we've talked about today, like the volatility in the market and potential future tax rates and things of that nature. So what are your discussions based around, and like even people watching this, what are some of the things that you could even hypothetically ask them that maybe they need to start thinking about?
Yeah, I think, well, I guess we could start with volatility because that's kind of how we started. And then we could,
that's fine.
Segue into taxation.
Okay.
But with volatility, if someone's retired or near retirement, you're just the nature of the demographics of our country. That's the majority of people we're going to talk to, right? Probably the majority of people we're going to talk to are going to be 50 or older.
Okay.
We're an aging country, so that's just the reality.
Yeah.
But I have some questions for almost everybody at any age, but generally the ones that really resonate are like before this financial crisis that we're in right now, obviously. But I would ask people who are close to retiring or already retiring who had quite a lot of exposure in stocks and equities. I would ask them, well, hey, how would it affect you if you, or what would affect you more if you missed out on a 10% rise in the market, or if you had a 30, 40, or 50% loss? And they're like, oh, wow, I didn't really think of that. Well, I'm retired, so definitely the loss would have impacted me more. Or, wow, yeah, I'm retiring in 10 years. A loss would impact me a lot more than if I missed out on some big gains.
Okay.
Well, if that's true, shouldn't we reduce some of your exposure here? Wouldn't that be a good idea? Okay. Yeah, we probably should do that. Or right now, some good questions could be, because after a lot of this artificial government intervention, the market is kind of coming back up. So sometimes some good questions could be, depending on a person's situation, well, we're the market's down, right? But over the last couple years, your account is still overall ahead, right? Like if you look at it from January to where we are today, maybe you're down. But if you look at it over the last 5 years or last 3 years, most people they're probably up, right?
Oh, yes.
So a good question could be, well, hey, we kind of rolled the dice. The market went down this year, but overall you're up. How do you feel about this recent volatility? How do you feel about these dramatic ups and downs? How do you feel about continuing on the path that you're on right now? You just hear what they say. Oh yeah, well, I'm gonna ride it out. I'm not worried. Well, maybe they're not the right person for some of the things that we do. Or if they're like, yeah, you know what, I kind of don't like it. I kind of don't like that. Well, you could lead into another question with something like, well, overall, over the last few years, you're still ahead. Like you're right. Down for this year, but you're still ahead. So, if you don't like the volatility, why don't we protect some of your account now? And if we leave some of your funds in the market, that way, if it goes up more, if it continues to go up, you're not going to miss out. But if it goes down again, we'll at least have some of it safe.
You know what? I think that's so wise because, I mean, if you look at And there's a lot of people that try to make financial planning so complicated, and it really doesn't need to be. I'm a big fan of the KISS principle. Keep it simple, stupid.
Yeah, it's all about what they want.
And if you look at like the money cycle that people go through with their lives, I mean, the first stage of that money cycle is accumulation. And I mean, that starts with your little kid. You put money in a piggy bank. Maybe you got your allowance or your babysitting money or your lawn mowing money. Maybe you open a junior checking account. Your mom and dad help you out with that. And then that continues into your working life and your career. Maybe you get a brokerage account, or maybe, you start a 401k. Maybe even your employer contributes to your 401k. And, you don't need that money for a long time. Like retirement is 30 or 40 years off. Mm-hmm. So, maybe you keep a small portion of that safe and liquid, and maybe you can take some more risk with a larger portion of that money because you don't need it for a long time. But then the second phase after accumulation really should be preservation, should it not? Like within 5 to 10 years of when you're going to retire, it's like you're financially secure. And now we have to start preserving and protecting some of this money that we worked so hard to gain. Because remember, it's not how much you make, it's how much you keep, right? Sure. Because if we see a big market downturn right before you retire, we're in trouble. And I'll come back to that and I'll speak to it in a minute. So we have accumulation, then preservation, and then the third and the final phase is distribution. So that's income to you in retirement, and possibly income in distribution of assets to your family upon your death. But the biggest mistake that I see retirees make is that they skip the entire preservation phase. They try going from accumulation straight to distribution, keeping their money invested really aggressively as if retirement's 20 years away, but it's not. And that's why that 3% rule exists, because most people don't ever switch their strategy with their money. And why is that a problem? Well, here's my personal story. People skipping the preservation phase, either because they got greedy, or maybe their advisor got greedy, or maybe it's a combination of both. Sure. Right. But when I worked in the mortgage industry coming out of the financial crisis, I can't tell you the amount of times I had phone calls with people trying to refinance their house. I'm trying to document their income. Well, I was retired, but now I have to go back to work. Or, I was about to retire, but now the value of my account is down 50% in the last 6 months. It's going to be another 5 or 6 years at least.
Yeah.
Do we have any equity we can get out of our house to help? Actually, no, because the housing market crashed too, and you're actually underwater. You actually owe more now than what your home is worth. Mm-hmm. And I had those conversations over and over, and it always made a mark on me. So when I transitioned into this business, I'm on a crusade to help people educate, or I guess for me to educate them, making sure that they're making good common sense decisions that feel right to them, but telling them the truth of the matter. And so you used the phrase earlier as far as like a volatility buffer. And, generally speaking, that means having between 5 to 10 years, probably closer to that 10-year mark, of safe money, income preserved for retirement. So if the market is good, you have, can have some money invested in the market. If the market's good, you can only always draw from that. But if the market is bad, that's not the only thing that you have. You have 10 years of protected income to draw on to let your other investments come back up with the market. Because we talked about it earlier with the sequence of return risks and how damaging that is to withdraw money from a depleted account. But man, if you can create a volatility buffer, you'll always sleep well at night, correct? Because you know that you're always going to have your short-term income goals met. You won't have to go back to work. You won't have to delay retirement. You can continue with the plan and feel good about it. Like you talked about it earlier, the secure and happy retirement. Mm-hmm. Right? Do you have any thoughts on that? Anything that you could add?
For sure. Yeah. And that kind of leads in really well to the distribution side of things, because if somebody has a source of income that is a non-correlated source of income, where kind of like a pension almost, right? Mm-hmm. Who are the happiest people in retirement? Are they the people who have $2 million in the stock market, or are they the people who have a $60,000 a year pension?
Interesting.
Who would be happier? Who would be less worried? Who would be less stressed? obviously the guy who has a guaranteed income, right? Wouldn't the person who has a paycheck that comes every month like clockwork, no matter what's going on in the economy, wouldn't that person have a far higher quality of retirement? Because retirement is, it's not only you're not working anymore, but it's a pretty big transition for a lot of people. You're uh, for someone who's working for what, 30, 40, 50 years, all of a sudden you leave your working career, maybe you really identify with your career, and now you're into a whole new phase of life.
Mm-hmm.
And on top of that, you're worried about how long your money's going to last while you're making this massive life transition. And now you have to worry about, well, while I'm trying to find myself in retirement, like, what am I going to do? Right.
Mm-hmm. Yeah.
I just left a job that I worked at for 40 years. What am I going to do?
Right.
Well, oh crap. Now I'm worried about what's going on with my money. And I'm worried about if I'm spending too much money, if I'm going to run out of money when I'm 85. Well, what if you didn't have to worry about that? What if you didn't have to worry about if your money's going to run out?
Well, it's so interesting that you said that, the example that you used, because the guy with $2 million in his portfolio, following the 3% safe withdrawal rate, that would give him $60,000 of income per year. Right. And that's, I mean, that's like a probable thing, right? He can probably rely on that. But, you know, if this was 2008, that $2 million is down to about $1 million within 6 months or so. And now he's ready to sue. So truly, who is more comfortable and confident and secure in their retirement? I mean, this guy with $2 million, would it make more sense? Like, hey, take 500,000 of that, or take $1 million of it and put it into some guaranteed income sources. You could keep $1 million invested. If the market's good, great, peel off some of those profits and go spend it. Right.
Yeah.
But when the market's down, you don't have to worry, because you have your guaranteed income and you have savings on the side that you can rely on. So it's like an entire strategy of having money in different buckets that are designed for different uses. And there's a lot of different, for that, the safety or the income bucket, there's a lot of different use products that you can use. Right. And that just comes down to a person's risk analysis and their goals. I mean, there's, income annuities and bond ladders and, CDs or money markets. There's fixed index annuity. There's a lot of like different safe products that you can use, like in that soon income type bucket. And then with their investable money, obviously there's a lot of different allocation strategies and things like that. I mean, we're not going to get into like investment advice on this show, but there's a lot of different ways to do it. But it's really, from what it sounds like you're saying, it's really about an overall strategy to have some safe money set aside, to have some money earmarked so you have income coming in regularly, and then you can have this other money over here, like in a later bucket where you can have investable assets. That's kind of what it sounds like you're saying.
Yeah. I think that's what a lot of people would really benefit from. And again, what we do is all on a case by case basis. So, it's not it's not like a blanket situation, but I think in general, a lot of people do benefit from having a good portion of their income coming in that they want to have in retirement be just entirely predictable and guaranteed.
Well, I mean, when you ask people, would you rather have would you rather have a predictable retirement or a probable one?
Right. Yeah, exactly. That's a great question. And when it comes to income, if somebody could have a portion or all of their income coming in for retirement be guaranteed, where they don't have to worry about running out of money, or they don't have to worry about volatility in the economy, they can enjoy life. They can enjoy their retirement. They can have fun. They can do what they want to do. And even if they live a simple lifestyle, which isn't bad or good, it's just personal preference. Even, they don't travel a lot, and they don't go out to eat a lot. They, live within their means and are very frugal. That's fine. But even a person in that situation, wouldn't even that person benefit from having I don't know, maybe all they need is $3,000 a month. Well, wouldn't they benefit if they had maybe $1,000 a month or $1,500 a month of that 3,000 guaranteed, where they would never ever have to worry about it, whether or not it's not going to be here.
So you mean $3,000 above Social Security? So how do we supplement that? Yeah. I mean, it sounds like you're working with a general strategy or a general framework that has enough flexibility that you can personalize it to somebody's specific situation.
Sure. Yeah.
Okay.
Definitely.
So in wrapping up here, because we've been going about 45 minutes, I think we've covered a lot of ground and had a great discussion. So in wrapping up, let's say somebody's watching this and they have some of the concerns that you're talking about. How would they go about getting a hold of you, to enlist your services or your assistance on some of these matters? Should they message you here on Facebook? Do you have, should they call you, email address? How should they get a hold of you?
Yeah, Facebook's a good way.
Do you have a personal website or not yet?
No, not at this time. A lot of the personal marketing type stuff that I do is generally over social media. So
we're kind of transitioning to social media mostly, aren't we?
Yeah.
Are you on LinkedIn?
I am. Yeah, LinkedIn. I don't really check it though. Facebook Messenger is a really good way to get a hold of me.
Okay.
Email is fine. I guess I could just throw out my stuff here.
Your phone number, or we could always
Mike.Raths, like my last name, RATHS, Mike.Raths at kofc.org, KFC like Knights of Columbus. And then 810-569-0370 is my cell if anybody wants to discuss things a little bit further. But that's Facebook would work fine though if somebody isn't connected with me personally but might want to chit chat a little more. Messenger or anything like that is I'll see it.
Great. So maybe when we end this discussion here, maybe I'll have you just go back to this video on Facebook and maybe just make the first comment, just your contact info, maybe your phone number or whatever the case might be, or a link, the link to your Facebook page or whatnot.
Yeah, that's a good idea. I could do that.
Okay. Awesome. Well, Mike, this has been a great conversation. Thank you so much for all your wisdom and all you do for your clients, helping them to, navigate these trying times that we're in. The good Lord has a place for you up in heaven due to all the good work that you do. But, more importantly, for being a great, husband and father and Catholic man.
I sure hope so. I don't want to commit the sin of presumption. So
yeah, keep fighting the good fight, man. All right, brother.
All right.
See you.